Hey, welcome to The Explainer. Today we're going to take a really hard look at the financial advice that, let's be honest, we all pretty much take for granted. You know the drill. Diversify, trust the experts, save for the long haul. But what if that advice is actually holding you back? So today we're going to dig into what it means to stop being a passive follower and start becoming an educated investor who is actually in control.
All right, here's what we've got on tap. We're going to kick things off by busting the diversification myth and then shine a light on the boilerplate investing trap. After that, we'll look at the huge difference between amateurs and professionals, and I'll lay out a 4-pillar framework to help you take back control. We'll wrap things up by talking about what it takes to build a real cash flow engine and what your new role as an educated investor looks like. Let's jump in. Okay, let's dive right in with a big one: diversification. I mean, this is the golden rule, right? It's the one thing everyone in finance seems to agree on. But we're about to see why this sacred cow of investing might not be the safety net you think it is.
Now, I know what you're thinking. Dangerous? Are you kidding me? Diversification is supposed to be the safest thing you can do. And look, you're not wrong. That is absolutely what we are all taught. But the idea we're exploring here is that the biggest danger of all is a false sense of security.
And you know what? That's a fair question. It absolutely is. I mean, don't put all your eggs in one basket is probably the first thing you ever learn about money, right? And it makes total sense. If one basket drops, you don't lose everything. But what if the problem isn't the basket? But here's the thing they don't always tell you. What happens when the risk isn't about one of your baskets falling, but about the entire boat you're on starting to sink? That's what the pros call systemic risk. It's when the whole market takes a nosedive. Think back to 2008. It really didn't matter how many different stocks you owned. The entire boat was going down. That's the kind of risk that simple diversification just can't protect you from. And this right here, this gets to the heart of the real danger. When you blindly trust diversification, it gives you this false sense of security. It lets you go to bed at night thinking everything's fine. But that complacency can make you incredibly vulnerable when a real market storm hits. It's like having a security blanket that's full of holes.
So you might be wondering, how does this whole false sense of security thing get packaged up and sold to millions of people? Well, that brings us right into our next section, what I call the boilerplate investing trap. Think of boilerplate investing like the fast food menu of the financial world. You walk in, they ask you a few simple questions: how old you are, what you make, how much risk you can stomach, and poof, you're handed a prepackaged, diversified portfolio. It's super efficient for the advisor, but it's often totally impersonal and has very little to do with your specific, unique goals.
And the process? It's pretty much a conveyor belt. You hand over your info, they punch it into some software, and out pops a standardized plan. Sure, it feels professional, it feels safe, but it's a generic solution for you, a unique person. The advisor basically hands you the keys, wishes you good luck on the journey, and that's often about it.
Look, this isn't about pointing fingers and saying financial advisors are bad people. It really is a systemic issue. Just imagine you're an advisor with, say, 1,000 clients. Now imagine each of them has just 10 different stocks. That's 10,000 individual positions you'd have to actively manage and understand. It's not possible. So this boilerplate model, it was really born out of necessity for the industry, not necessarily for what's best for you, the investor. Okay, so all of this leads to a huge split in the world of investing. It's like there are two totally different games being played, sometimes with the exact same stocks. So let's break down the real difference between the amateur and the professional investor. First up, and this is probably the biggest one, is the goal. The amateur is totally focused on capital gains, on growing their net worth. The whole game is buy low, hope it goes up, and sell high to build this big pile of money for someday, way off in the future. The professional? They're focused on cash flow. They want to create spendable income from their assets right now, today. Next, let's talk about how they handle risk. It's night and day. As we've seen, the amateur just relies on diversification. They spread their money around and just kind of hope for the best. The professional, though, uses specific tools, contracts like insurance and options, to actively manage their positions and control their outcomes. One is passive hope, the other is active control. And finally, where they put their focus is just a world apart. The amateur, well, they're kind of stuck on a hamster wheel, always looking at their income statement. They're thinking, I need to get a raise, or maybe I should get a second job. The professional is more like a gardener, totally focused on their asset column. They're thinking, how can I buy or build another asset that produces income? One mindset has you working for money. The other has your money working for you.
And this is why so many of us have felt that pit in your stomach, right? You buy a stock, it starts to drop, and you just freeze. You're paralyzed. Should I sell? What if it goes right back up? Should I hold? What if it goes to zero? That feeling of panic and uncertainty, that's the classic sign of the amateur mindset, because there's no real strategy beyond just buy and hope.
So the big question is, how do you get off that roller coaster of fear and move into the driver's seat? Well, the answer isn't some hot stock tip. It's about two things: education and control. So let's look at the framework for getting there, which I call the 4 pillars.
This right here, this is a game-changing idea. See, most of us are taught to think that risk is just something out there to be avoided. But a professional investor understands that risk and control are opposites. The less control you have over something, the riskier it is. The more you know, the more control you have, the less risky it actually becomes. Okay, so these are the 4 pillars that give you that control. First, there's fundamental analysis. Basically, do you know what you're actually buying? Can you read the report card of a company and know if it's strong? Second is technical analysis. This is about reading the room, understanding the mood of the market by looking at charts and patterns. Third, and this is huge, is cash flow. This is the skill of making money from your assets no matter which way the market is heading, up, down, or sideways. And finally, risk management. This means you're actively protecting yourself using tools like options, kind of like buying insurance for your portfolio. Mastering these is what makes you a pro. All right, so once you have this new way of thinking, the goal isn't just some fuzzy dream of being rich anymore. It becomes something real, something tangible that you can actually build, your own cash flow engine.
And this is it. This is the end game. Financial independence isn't about having some giant number in a retirement account. It's a simple equation, really. When the money your assets make for you every month is more than the money you spend every month, you're free. You are no longer dependent on a job for your survival. That's it.
So, where on earth do you start? It sounds huge, right? Well, you don't try to build the whole engine at once. You start with one tiny gear. The very first goal is so simple, but it's psychologically massive. Just make one single dollar of income that you didn't have to work for. That first dollar, whether it's from a tiny dividend or something else, proves that this whole thing is real.
Because once you've made that first dollar, you've cracked the code. You know how to make another one. And once you can make $10, you can figure out how to make 100, and from 100, 1,000. It's all about building that skill and that belief, brick by brick. Every small win creates the momentum for the next one. And at the end of the day, it all boils down to this choice, doesn't it? Are you hoping, just putting money into a 401k and crossing your fingers, relying on a market you have zero control over? Or are you building? Are you taking active, deliberate steps every single day to create your own income? Okay, this brings us to our final and honestly most important point. When you adopt this new mindset, it changes everything. It changes your relationship with money, with the financial industry. It totally redefines your new role. And this is a really important takeaway. The goal here isn't necessarily to just go out and fire your financial advisor tomorrow. It's to completely transform the relationship. You stop being a passive student who just takes notes and you become an active, engaged partner. You shift the dynamic from them talking at you to you talking with them. Think about what happens when you're educated. Suddenly, you can ask way better questions. You actually understand the strategies in the trades they're making with your money. You can hold your team accountable because you speak their language. You can spot that boilerplate, one-size-fits-all advice from a mile away. And most importantly, you take ultimate responsibility for your choices, because now you're equipped to. So, I'm just going to leave you with this one last thought. Your financial advisor might have hundreds, maybe even 1,000 clients, but you only get one financial future. So who cares more about your money than you do? Taking control of your own education isn't just a nice idea. It's the only way to truly own your financial destiny. Thanks for watching.